Hello traders, and welcome back to the Forex Geek, where we dive deep into the tools that can help you make smarter trading decisions. So in today's video, we're going to be talking about the bearish separating lines candlestick pattern, which is a specific market formation that signals potential trend continuations in downtrend markets. So you discover how these two candle patterns this reveals crucial market psychology. You discover when to enter trades with precision and the exact conditions needed for optimal execution. So stay until the end to learn the step-by-step strategy for identifying and trading this pattern, including the common traps many traders fall into. So without wasting much of your time, let's get started. So the bearish separating lines pattern forms during a downtrend and consists of two distinct candlesticks that tell a clear story of market control. So let's break down what you are looking for in this pattern. So the pattern begins with a strong bullish candle, and this is your first signal, this candle right here. And the green candle shows buyers attempting to reverse the downtrend. So initially we were in a downtrend with more of bearish candles, and now this is where we are right now, and you have a bullish candle attempting to reverse the downtrend, creating a notable upward move in price. So what makes this pattern unique is the second candle, which is the bearish candle, the red candle. It opens at exactly the same price, or slightly a little bit different, just slightly at the same price, or at the same price as the first candle. But this candle closes significantly lower, creating a bearish candle that demonstrates sellers regaining control of the market. So when you spot these two candles forming in sequence during a downtrend, pay close attention. The equal opening prices between these candles are crucial, and this shows the market's indecision at that exact price level before sellers take command. So remember, this pattern becomes particularly significant when it appears at key resistance levels in a strong downtrend, or can also be used as for continuation in a strong downtrend. So let's just hop on the charts and look for this candlestick pattern. So we have one here, and you can see price has just given us a double top right here. Price has just given us a double top candlestick. I'm just gonna okay, so this is the neckline. Remember, I said you should always look for this candlestick pattern with proper market context, which involves price action and also the use of other indicators like your moving average or your RSI. So we have the bearish separating line candlestick pattern forming here, and you can see this green candle. So this green candle attempting to push price upwards, but we have the red candle, the bearish candle, opening at the same price with the bullish candle, the first candle. Now if you look at that, is almost the same thing with this my illustration here explaining the bearish separating lines candlestick pattern. So this is exactly how it is, and once you spot this pattern, you should be looking for selling opportunities in the market. You could hop on the lower time frames to look for confirmations, or if you're the type that like to enter on the daily or on the 4-hour, you could just enter at once. So it's always important to trade with the higher time frames because they give more reliable trading signals. So this is another one right here, and you have this. So you have this bearish trend, and we had this price pushing had this bullish candle pushing price higher, looking to reverse this trend, but we had this next candle, which is the bearish candle, open almost at the same level with which the first candle closed. Now this signals that we should be looking for selling opportunities in the market, as we have just seen the bearish separating lines candlestick. If you need additional market context, you can see we had a break of structure right here, and this was just a pullback back into premium to continue the sales. You can use your Fibonacci from here down to here, and you can see price, all we had was just a deep pullback into the 78.6% region to continue these sales. And this bearish separating candlestick line candlestick pattern that we had here is just a continuation. It was just used for a continuation for this bearish trend as we went down to break structure. So that is, let me look for another example. So this is on Intel on the 4-hour time frame, and you can see we are bearish. We've been bearish on Intel actually. So had this bullish candle attempting to push price upwards, and you have the bearish candle opening almost at the same level with the first candle, the close of the first candle. So this signals that we should be looking for selling opportunities in the market, and we could look to enter or go down on lower time frames for confirmation. So now that you understand what the bearish separating lines pattern look like, let's focus on how to trade it effectively with a systematic approach. So your entry point should be placed just below the low of the second bearish candle. So for example, with the first candle, the first example we had here, your entry point should be placed below the low. I was going to take the short position. So below the low of the second bearish candle, and this confirms that sellers are maintaining control and the downward momentum is likely to continue. So you could just look to enter your trade position here, and your stop loss placement should be above the high of the bullish candle, and this level is crucial because it if price moves above this point, it invalidates the entire setup. So your stop loss could be right here, and your take profit should be a 1:2 or a significant support level, because this is a continuation for the bearish trend. This could be a good take profit level, but for this particular trade we took a loss for this particular trade actually. So let's just go to the next example so that we can better understand. So you can see this, for this example we had the bearish separating lines candlestick pattern. So our entry position should be at the close of the second bearish candle after this, and you'll be looking at this, and your stop loss should be above this high, and your take profit can be at a significant support level like this one, or you could just aim for a 1:2, as you can see. And that's how we're able to catch this bearish trade using the bearish separating lines candlestick pattern. Also, our advice, you could maybe go to lower time frames like the 1 hour, because we are on the daily right now. You could go to the 1 hour to look for better confirmations or trading opportunities, because now we have the overall bias, which we should be looking for bearish momentum and bearish activity. So after spotting this bearish separating lines candlestick pattern, you could just go to the 1 hour or the 2 hour to find some significant selling setups from that level. So this is another example. Remember, your entry should be at the close of the second bearish candle, stop loss above the high of the bullish candle, and the take profit should be a 1:2. So this was a free fall. Okay, we have a support level here, and we could just take profit right here, or we could look to continue the bearish trend. This was a significant bearish trend on Intel, and we could just be looking to continue the bearish trend and keep increasing our take profit to support levels, but remember to always take partials in trades like this, and also set your stop losses at significant points, also set your break even, and also you could set it at significant resistance levels. Exactly. So when setting your take profits, is advisable you look for a minimum risk to reward of 1:2, and this should be maintained for each trade. I'm just gonna take it to 1:2 because that's the ideal. And position sizing is critical for this strategy, so never risk more than 1 to 2% of your trading account on a single trade, regardless of how perfect the setup appears. For example, you can see we took a loss here, and if one was risking almost all of his account, he would have blown his account right here. So 1 to 2% is always advised. So let's examine common mistakes you should avoid when trading the bearish separating lines candlestick pattern. So the most dangerous mistake is ignoring the overall trend. This pattern only works in a clear downtrend, so attempting to trade it in sideways or choppy markets will lead to false signals. Another common error is rushing into trades without confirmation. You must wait for the second candle to fully close before entering your position. Many traders jump in too early only to see the pattern fail. So you should always look for your confirmation, which is the second bearish candle, to fully close. So trading this pattern without considering key support and resistance levels can be costly. This is another error and mistake to avoid. So the pattern becomes significantly more reliable when it forms near major resistance levels. Like we had a resistance level here, and price had just tapped into it, and we were looking to hit this level and go down to break structure, and then we had the pattern form right here, which is expected to push price to break structure here. So over reliance on this pattern alone is a recipe for failure, so always combine it with technical indicators and volume analysis for better confirmation. So right traders, you've come to the end of this video. Engage with us in the comments below. We want to hear about your experiences using this indicator and candlestick pattern. If you found this video helpful, don't forget to like, subscribe, and turn on the notification bell so you never miss out on more trading tips and strategies. Thanks for watching, and I'll see you in the next video.